Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay, and this looks like the calm before the storm, after the storm. But you know, it's just that it's not held up, right, at those high levels that we had in the morning.
Let's just hope it's not what you first said, that the calm before another storm, right? But I think that's the market's worry, the durability of this recovery. We've got these sharp pullbacks across Asia, but we need to see if the worst is really behind us, Reema.
But you know, as of now, at least the markets have come off from the session highs. The high today on the Nifty was a level of 24,382. So from that level, we've given up close to about 150 points, though in the last 15 minutes, there has been some pickup in the markets. But globally, things have bounced back. So the Japanese market, Nikkei, is up 6.5%. Taiwan, Korea is up close to about 3%. The problem for our market is banks. So the Nifty bank is flat. It's not participating on the way up. And many of the large cap banks, like an ICICI Bank and HDFC Bank, though they've recovered in the last 15 minutes, are still trading in the red. Today, top honors go to the IT space. Remember, yesterday, all the sector stocks indexed to global growth were under pressure, and that's where the maximum bounce back is. So IT is leading from the front. Nifty IT up 1.8%, HCL Tech Mahindra 2.5% gain, and even the others like Infi TCS up 1.5%.
Absolutely. So that's the way we're looking at things right now. At least the mid-cap market is holding up. Yeah. So let's see. It's still early days into the day. It's just 11 a.m. I thought, we'll start off with two very interesting calls that we're getting on yesterday's carnage from two different financial houses. Let's start with what Mahesh Nadurkar's view is. He's, of course, from Jefferies, and he says that higher risk of a U.S. downturn now factors in 132 basis points Fed rate cut by the end of this year. That's December 24. The consequent U.S. dollar weakening should augur well for Indian stocks on a relative basis. But on an absolute basis, the risk is on the downside, given one of the longest streaks of the bull run, unsustainably high domestic retail flows, and potential capital gains tax hikes in the future. He maintains a defensive stance, and their preferred large-cap laggards are private lenders, staples, L&T, and two-wheelers. So that's the Jefferies call. They do remain a little cautious on the market. Let's look at what Macquarie is now saying. This is coming in from Victor Schwetz of Macquarie, who says that the sell-off was precipitated by a confluence of events. That is the perception that the Fed is behind the curve, investor concerns that the tech bubble is bursting, and third, potentially disruptive unwind of the yen carry trade. Although stampedes, he says, are inherently unpredictable, their view right now is that this is closer, and this is quite close to irrational, thus creating a buying rather than a selling opportunity. So you have one cautious view, one slightly bullish view. Macquarie saying probably this has created a buying opportunity. So we need a tiebreaker. And therefore, let's bring in Mihir Vora, Chief Investment Officer at Trust Mutual Fund. Mihir, I hope you've managed to have a good night's rest. It was a roller coaster day yesterday. But to weigh in on everything that's happened, I mean, the US recession concerns on one side, this whole yen carry unwinding on the other side, and where we are. Are we past the worst?
Good morning, Surbhi. See, are we past the worst is a very, very broad question, I would say. But I would say that yesterday's fall was not a reason to sell. And today, if the market goes up 1-2%, would not be a reason to buy. Because ultimately, what we need to keep in perspective is the fact that over the last few weeks, the absolute confluence of Goldilocks kind of tailwinds that we had are kind of reducing or slowing down. So a few weeks ago, we had the US economy on a roll with the Fed changing its stance to a little bit of neutral to maybe even a little, dovish. We had the Indian central banks do what they've been doing, in a sensible fashion. And we had continued retail flows and some pickup in FII flows over the last few weeks. So it was a combination of fact that US and global growth is a tailwind. India, anyway, growth was expected to pick up after the monsoons, and retail flows are supporting the market. I think that situation has changed a little bit, as you mentioned, because of the sharp reversal of the yen carry trade. My view is that this trade has been building up ever since 2020, 2021. So it's been almost 3 years of this easy money, borrowing in yen and investing in all sorts of risk assets. That trade has been building up over 3 years. So I don't think it's going to unwind in like a day or two. it will have a bit of a trickle-down effect or ripple effects throughout various markets. For example, while we were looking at stocks yesterday, even the cryptocurrencies were down sharply. So you really don't know where exactly all the flows have gone, where all the borrowed leveraged money globally has gone. So it's not going to unwind in a day. So as I said, yesterday was of course a culmination of a lot of factors, and the kind of moves that we saw, 3 sigma, 4 sigma kind of moves that we saw, probably will not repeat too often. But that does not mean that every problem or every leverage trade in the world has been unwound yesterday. So as I said, just because the markets were down yesterday was not a reason to sell. Just because the markets are up today may not be a reason to buy. So in the medium term, I think we should stick to the overall investment thesis for Indian markets, which is that through thick and thin, at least for the next few years, India will continue to remain amongst the relatively fastest growing economies in the world. Demographics, etc., we all know are on our side. And plus, more importantly, we are probably already past the peak tightening stance by most of the central banks. So while of course Japan hiked, but they had different reasons for that because of the currency issues. But most of the central banks are now in a cutting mode. So after the sharp Fed hikes that we saw ever since 2022-23, now of course we are talking about a cut cycle. So I think even if the US slows down, the Fed will start cutting rates actively now or in the next few quarters, and that should continue to give a buffer to the market. So if there is gut-wrenching volatility, I would not react negatively and use that as an opportunity to buy. But just because the markets are down on one day doesn't mean I go out and put all my money in one shot. So I think level-wise, as you did mention, Mahesh also mentioned that valuations, of course, were a bit frothy in some of the pockets. So I think we need to stagger out our investments level-wise as well as time-wise, with the clear view that the Indian economy is relatively amongst the better places to be.
Valuations were excessive. India's market cap to GDP had hit 150%. And the last time we were at that level was in 2007. And we know what followed, the crisis which precipitated. So we are not looking at 1-2 day index moves across the global markets, which are impossible to predict. But what about for the next 6 months? Is the outlook for equities looking a little less rosy because US growth may falter, whether or not we get into a hard landing or recession? But growth is now being questioned in the US. Slowly, this yen carry trade is unwinding. That trickle-down effect will take place slowly. So what's the outlook for global equities for the next 6 months?
See, volatility is going to remain heightened for sure, which means it's on both sides, right? You'll see whipsaw moves both on the downside as well as upside. So it's very, very crucial to keep fundamentals and valuations in mind, stock-specific fundamentals and valuations in mind. And I think every carnage or every sharp move in the market does give opportunities, brilliant opportunities, because our canvas, luckily for India, is so high that you can always pick and choose stocks. So because I'm sure everybody has a list of stocks which they missed, and if there is a correction, a sharp correction in the market, you should keep that list ready and be prepared. But very clearly with a 1 to 3 year type of a time frame. I don't think the volatility that has begun is going to end very soon. So we have to continue to live with the volatility for the next few months, and make sure that we own good quality stocks that we always wanted to own, and stick with them for at least 1 to 3 years.
1 to 3 years, that should be a horizon if you get in now. Take that point, Mihir. But do you see, because of the events that have unfolded in the last 2-3 weeks, do you see market leadership changing? Because through thick and thin, over the last, I think now 18 months, if not longer, leadership has remained with PSUs, with CapEx, economy-facing stocks, whereas private banks, FMCG, they've been laggards. Do you see that changing at all?
Certainly. I think in some of the segments, which of course you mentioned, there is a lot of action happening. So there's no denying the fact that these are likely to continue to be growth sectors for a while. But in the last few months, we had too many thematic funds being launched, probably chasing a limited set of stocks, and valuations in some pockets because of that did go up significantly. So I think some of the segments which are, as you mentioned, domestic facing, like banks, financials in general, which are non-lenders, including, insurance, wealth management, capital market linked stocks. Those should provide a good buffer, and there are certain stocks and business models in that which can see secular growth. So I think some of those ignored sectors which have been underperforming for some time may come back into the limelight. As we mentioned, as we discussed, we are probably past the peak of the tightening cycle. So gradually, you should start to see all the issues with deposit growth, etc., for the banks and NBFCs recede, and that should ultimately translate into not only volume growth, that is credit growth, but it should also translate into better margins over the longer term. So I think in the next 6 months, we should get a good tactical entry point into some of the lenders and non-lenders. So that's one. Second is discretionary has been quite volatile. And I think that in the last 3 years, while we have seen pockets of growth, like say cars recovered quite well, two-wheelers are beginning to recover. But if you look at the overall consumption and discretionary space, our volumes on an aggregate are only a little above or at levels which were there at the pre-COVID level. So I think the penetration story has really not played out in some of those discretionary names. Whether you talk about auto ancillaries, or you talk about eating out, and all those kind of things. So I think there is still scope for the broad macro theme that we always want to play, which is increased penetration, increased prosperity, etc. So I think consumption also within that discretionary can offer good opportunities in a correction. And third, of course, I think we have been talking about pharmaceuticals, which are now coming out after a long period of issues with the FDA, etc. And you are looking at companies which are now doing not only basic API kind of work, but the CRO and CDMO space is also becoming quite exciting. So a lot of stock picking in sectors like pharmaceuticals. So I think domestic link sectors, some of the pharmaceutical names look good. I continue to believe in the physical asset creation story. So all those names in the real estate infra, all the domestic names should continue to do better than the global facing names like IT, metals, energy, etc.
Okay, very helpful advice, Mihir. Thanks very much. Plenty of food for thought there for investors as they look at some tectonic moves over the last couple of hours in global markets. Thank you so much for joining in. We look forward to the next call. We'll take a break on that note, come back on the other side, and we not only touch base with Manisha, figure out how the commodity markets are doing, if they've stabilized today, but we will also get a global voice in. What next? After the big storm, is the worst over? How are global investors looking at the pullback across Asia today? Welcome back. So focusing on commodities, equities are trying to look at some semblance of sanity and stability after yesterday's massive moves coming to commodities. We have Manisha joining. I think she's looking at oil in particular, because all of this, led to a big drawdown in oil as well in the last 24 hours. But Manisha, hi, morning. What's the situation today?
Well, slightly sane, as you said, in various other asset classes also, and the crude oil prices also seem to be getting some opportunity buying there. After that 3.5% decline in the markets yesterday, we are trading more than a percentage point on the higher side. Well, the support also comes because the US ISM numbers that came in yesterday were slightly on the supportive side. Well, this after a string of weak data that we have seen come in from US, or fears of recession in US as well. So this one economic data actually seems to be supporting markets. Having said that, the weaker data from China and Europe have pretty much continued. You also are looking at weak demand. If you look at the first half of 2024, the imports within Asia, especially within China and Europe, have been on the weaker side. So that will continue to weigh onto the markets, is the reason that you're looking at Brent prices trading at 77 right now. The high that we've seen in 2024 for Brent has been at $94. So from those kind of levels, still on the weaker side there. The other reason that you saw support come back in was reiteration of escalation of war within the Middle East. There have been statements from Iran and Israel as well. So that premium also seems to be coming back in prices. And apart from that, production has been halted in Libya's largest oil field, Sharara. And that also is a premium that you can see in case of prices. For the week-on-week basis, we are still down by about 2%, down by 11% in last 1 month as well. But after those declines, there is definitely some buying opportunity that you can see on the screen.
Okay. All right. Thank you very much for the latest there, Manisha. So some recovery in oil prices as well. Now, is this recovery durable? That is the question on investors' mind across asset classes, across geographies. Let's ask Fu Keen, who's a senior investment strategist at Standard Chartered Bank. Fu, thanks very much for joining in. I'm sure it must have been a very interesting last 24 hours for you as well. I was going through the note that you folks put out yesterday, when the dust had kind of settled. So just take us through the thought process. Now, I believe a lot of officials are supposed to be meeting in Japan now at this hour to take stock of the carnage. I think the first question is the worst of the yen carry trade unwind over? Is there more to go? And will we see another round of volatility?
Yeah, no, thanks very much. Thanks for having me. I think the yen, we've got a view that for dollar yen of around 146 in the next 3 months. We think it went down. It got close to testing 140, which was the low back in December 2023. So we think that is a support level, testing to the 140 level. It got close to there. So we think that would be the support level. So we do expect it to be a bit calmer at a 146, as I said, our view for the next 3 months. So a lot of it has been unwinding. We think positioning has been very much short of the yen. With the move from the Bank of Japan last week, there was a bit of a surprise. I think there's a lot of unwinding of the carry trade of the yen, where people have been borrowing yen and using that proceeds to invest in assets around the world. So that has been unwinding a lot in the past 48 hours, I'd say.
Fook, morning, Rima here. So what's the expectation for global equities for the next 3 to 6 months? Because your technical model had turned bearish on S&P 500 index for the first time in 2 years. And we saw the kind of sell-off over the last 2 or 3 days. What's the near-term outlook?
Thanks for that. I'm glad you picked that up. So you're right. The first time in 2 years it turned bearish, and it's been a positive up until that point. So I think in the near term, I think in terms of the volatility and whether we see the bottom or not, I think we're still quite cautious there. But look, over 6 months, our view really is that we still expect global equities to outperform. What's going to be crucial really is whether the US can get a soft landing, whether it can get into a recession. Now, a lot of this, in my view, started after the non-farm payrolls, the employment data, unemployment ticked up. So there was a bit of weakness there. So we've seen soft landing pretty much expected by a lot of economists across the street. But when that data just raised the possibility and a repricing of whether we can actually have a hard landing, I think that is what is causing a lot of the tailspin in the market. Look, our view is that rates are very high at a 23-year high. There is scope for the Fed to cut rates, and as they cut rates, they can then extend the economic cycle and support a soft landing. So that is our core or our base case, if you like. And if the Fed is able to achieve that by cutting rates and extend the economic cycle, as they're focusing on growth, we do expect global equities to outperform cash over the next 6 months. So that is our view for next 6-12 months. We're still constructive, but in the near term, as you say, we look at our technical model and positioning. Actually, that hasn't actually washed out yet. So we're still very cautious, expect volatility in the short term.
So one piece of the puzzle is the US and whether we get that soft landing or not, or if how the Fed responds, and we'll have to wait and watch, because I think everyone's anticipating now 100 basis points, if not more, rate cuts by the end of this year. So that's one part of it. Fook, to get back to Asia, now we all understand that no one can ignore large markets like Japan, right? I believe you've already closed out, your team has closed out the short USD yen sort of positions. Do you think the maximum amount of this yen surge, is that over, or should we be prepared for any other surprises for Japan? Because I don't know, I mean, can the BOJ suddenly change course? They hiked rates, they were talking about tighter policy. But would they suddenly change course just because the financial markets are freezing up?
Yeah, look, I think that the surprise last week was what really the market didn't like. It was 50-50 going into the meeting, and then they came out with the hike, raising rates to 0.25%. And the market really doesn't like the uncertainty. We think the signs are there that inflation is picking up, and that's why the Bank of Japan acted. And we think that the trajectory really is for further normalization of interest rates. I mean, 0.25% is extremely low rates. They has exited negative rates back in March. So look, we're looking at normalization of policy here. And why are they normalizing? Because inflation is picking up. There's reason why they're doing that. So we do expect that normalization to continue. I think in terms of the communication and how the markets are digesting it, that could take time. Whether the yen carry trade happens or not, look, I mean, there's a lot of different factors in there. As I said, our 3-month view is 146. So pretty much where the market is, we think 140 is a bit of a support. But if you look at the differentials in terms of the yield that you get on Japan versus US, yeah, I can see the arguments there. But in terms of the trajectory, we expect where the Bank of Japan is going to be raising rates compared to the US where they are reducing rates. I think that's a trajectory that we can expect where the differential will narrow.
Yep, absolutely. We're living in very, very interesting time where these two large central banks, powerful central banks, are moving in opposite directions. So let's see if we get to equilibrium or not on rates and what that means for global asset classes. Great conversation, folks. Thanks very much. And we look forward to having more frequent chats as we understand how central bank policy moves over the next couple of weeks. Thank you for joining in today. We'll take a break on that note. Coming up on the other side, we will be in conversation with Rajan Sethuraman of Latent View Analytics. So we'll talk about the company's first quarter performance and the outlook.
Welcome back. Let's get a corporate conversation going now. Latent View Analytics is in focus. They reported their Q1 numbers a few days back. It's a good start to the year, a 21% year-on-year revenue growth, and profits too have gone up 18%. Margins, though, under pressure on account of wage hikes. We have with us Rajan Sethuraman, Chief Executive Officer of Latent View Analytics, on the show now. Morning. Thank you very much for joining in. It's good, 21% on a year-on-year basis. But I remember the previous conversation where you had indicated that, maybe we'll try pushing for a 6 to 7% quarter-on-quarter revenue growth. Compared to that, this quarter you've done about a 4.5% Q1Q revenue growth. So has this quarter growth fallen short of your expectations? And if yes, what led to this shortfall?
Yeah, good morning, Rima. Yeah, you are right. It is definitely short of our expectations. We were expecting it to be in the 6.5% range. The key reason is one, the larger initiatives are taking longer to close. We had a few deal closures, but they ended up closing in the early to mid-June timeframe rather than at the beginning of the quarter. So that had a bit of an impact. And then there are some opportunities that are getting delayed as well, or people choose to do a pilot first before they launch a bigger opportunity. So all these things are playing out. The outlook is still fairly positive for the year in terms of what our original guidance was. We are fairly close to that. But yeah, slower start than anticipated.
So next quarter, because some of these large initiatives have closed in June, do you think next quarter you can push for a 6 to 7% kind of revenue growth?
That's what we are looking at this time. And it looks more promising definitely than the first quarter.
Okay, so Q2 should be better than Q1, and again, you will try for the 6 to 7% kind of revenue growth. What about for the full year? You've given a guidance of 16 to 18%, but that doesn't include the Decision Point acquisition that you all concluded. So what will the overall growth look like, including the acquisition?
So Decision Point did about 12.8 million last year. We will get the benefit of the consolidation only for 3 quarters. But we are expecting them again to do about 14 million or so, 14.5 million, right, in terms of total. We will have to look at the exact numbers in terms of, we are actually looking into the details of their first quarter at this point in time, right, and where the second quarter will end. So I'll give a better view maybe closer to the end of this quarter. But overall, including the inorganic, I think we should be closer to the 25% plus kind of a number.
25% plus top line growth for this year, right? That's what you're referring to, which is fantastic, sir. I mean, given the rumblings that we are hearing of now with a lot of talk about the US economy slowing down, recession, question marks being raised. Is that a concern at all? Because at 25%, I mean, that doesn't seem to be factored in. So what is it that you're hearing and seeing?
Yeah, so the last 2 days, obviously, things, everybody has been caught by surprise. So we haven't fully factored in if that is going to have a big impact. In general, I mean, a lot of the opportunities that we have been pursuing and even what decision point has been, they all are fairly close to fruition, right? In terms of the actual closure happening and revenue starting to come in. We are seeing some tentativeness in general, right? But that has been the case for the last 12 to 18 months. Whether the last 2 days will have a big impact, it remains to be seen. But taking that out of the equation, right? We were really looking at a 16 to 18% for organic and a 25% plus, right, in terms of inorganic growth.
And good you clarified that your guidance is based on a lot of deals that are close to fruition. So, I mean, therefore, those numbers are not sort of long drawn out conversations. So got that point. Just a word on margins as well. You're at around 21.5% now at the start of Q1. You're saying 23% is possible by the third quarter. Just take us through the levers here. I mean, is there any sort of a pricing lift in this? Or, I mean, so how do you get back to 23 and will that be a sustainable run rate then going forward?
Yeah, not too much of a pricing lever. There will be the pricing adjustments that we will shoot for as part of renewals and so on. The real impact will come on account of leverage, operating leverage. Like we have said earlier, most of the investments that we wanted to make, whether it is on marketing or capability building or the front end, that's all done. There will be a little bit of adjustment that we might do from one area to another, but we're not expecting to add significantly in terms of the percentage of revenue, right, getting invested right on the front end and so on. So therefore, as the revenue growth comes in, the margin lift will happen automatically. Most of it will fall through to the margin. And we are expecting the 6-7% kind of number, right, quarter on quarter. So that's what will help us move the overall margin, right, for the year closer to the 23.5%.
Okay. 23-25% by the end of the year is the exit margin, right?
23.5. Yeah.
23 to 23.5. Okay. Your Gen AI pipeline is about $4 million, you've indicated. How much of that could get converted into revenues? Can Gen AI contribute to your revenues in the current year? Or for FY26, do you have any estimates? And a quick word, because you've specifically called out retail as a sector where there are headwinds. What is happening on that front with your clients?
Yeah, Gen AI, we already have about $1 million of revenue in the bag, I mean, which we are executing against. The $4 million worth of opportunities in the pipeline, they are also looking very promising. In general, there is a great deal of excitement. I would say that about 20% of the conversations that we are having today has Gen AI in the mix, either as a core Gen AI kind of a project or Gen AI being leveraged, right, to democratize decision making or making the information available right in the hands of the people. So I'm fairly optimistic that a lot of that pipeline will get converted right as part of revenue for this year itself. On the retail front, yeah, in general, it has been a fairly difficult place for quite some time now. This coupled with the fact that many of the larger retailers, right, I mean, the top 4 or 5 retailers, they're all going the GCC route and they are bringing a lot of stuff in-house. So in general, there has been a slowdown, right, on account of that. Our focus is now more on some of the tier 2 retailers and some of the media-based retailers, for example. Right? So we are looking at opportunities there because that's where, again, you can make use of data analytics, right, to create the kind of competitive advantage. But having said that, I would say that retail, we are more optimistic, more on the marketplaces side, which are digital in nature, as opposed to the core traditional retail itself. Now, again, based on what we are hearing in the US, that will have some kind of impact, right, for the remainder of the year as well. So it remains to be seen, right, how that pans out.
Okay. But in terms of the large retailers, you seem to be losing work to the GCCs. Thank you very much for explaining that. It's been a great conversation, but we need to get into a short break. On the other side, we'll invite the management of Unicommerce Solution. The company's IPO opens today.
Hey, thank you for watching this on CNBC-TV18. Hope you liked it. For more such interesting news and updates, follow CNBC-TV18 on all the social media platforms.
back. Let's talk about Unicommerce eSolutions. They're all set to make their debut in the exchanges. The company's IPO has opened today and the retail book has already been fully subscribed. Kunal Bell, promoter, non-executive director, and Kapil Makhija, the MD and CEO of the company, are now with us to talk about the company and the plans post the IPO. Gentlemen, thank you very much for joining in. Kunal, let's start with the company first. You're a SaaS company and you're also indexed to e-commerce in India. So what exactly does the company do and who are your big clients? Because your growth is dependent on them.
Sure. Thank you, Rima, and thank you, Surabhi, for having us. Unicommerce is essentially a SaaS company. We sell software products to companies that sell their products online, either on their own website or the marketplaces, various marketplaces. We take care of the operations from a software standpoint, post the customer clicking the buy button. Everything that happens behind the scenes, where as it pertains to managing of warehouses, managing of inventory, figuring out which inventory should be listed on which marketplace, shipping tracking, payment reconciliation, various operations, the myriad operations that an e-commerce brand needs to conduct behind the scenes, we simplify it using software. So some of the leading brands, both digital native and digital migrant brands, are our customers, the likes of Mamaearth, Boat, Imami, Fab India, and we have 3,500 customers.
Okay. You've always said in your previous interaction with us that you've grown faster than the industry and eventually you would like your margins to rise to the EBITDA levels of other SaaS companies, which is typically 25 to 30%. So two questions. One, what is the industry growth rate? The next 3 years, 5 years.
Sure.
And secondly, how soon do you think you will be able to scale up your margins and hit that steady state?
Sure. Maybe if I take a step back, essentially Unicommerce is an index to the e-commerce volume growth because we make money on a per unit shipped basis, right? So on every unit shipped, we make a small amount of money. So today in India, there are 4 to 5 billion e-commerce shipments a year. Compared to that, China is at 150 billion e-commerce shipments this year. So 30 to 40 times that of India. Over a period of time, as India's e-commerce volumes grow, one would like to believe that given Unicommerce is an index to e-commerce volume growth, Unicommerce should also grow. Yeah. In terms of margins, this business has very high operating leverage. It has high gross margins. We don't do custom software. We sell software products. So the margins are in the 78 to 80% gross margins. And as a result, what we are seeing is as the revenues are growing, more and more percentage of that incremental revenue is going to the bottom line. So last year, about 50% of our revenue growth went to the EBITDA.
Kapil, if we could just, and I know you can't give too many forward-looking numbers right now, but just to understand the growth trajectory, between I think FY22 and 23, there was a significant bump up in growth, but then the subsequent year was more flattish. I think 90 went to about 100 CR. How do you map the trajectory going forward in terms of the opportunity, which seems to be very large? I mean, e-commerce is only booming in India, and also the competitive intensity. Who are the competitors in the market, and what should your investors expect from you, say, 2 years from now?
Sure. First of all, thanks for having me here. I think as Kunal mentioned, we are an index to the e-commerce. We have always delivered a growth which is faster than the market. The e-commerce market grew during the pandemic at 30-35%. We delivered nearly a 50% growth. Last year was probably the slowest year I have seen in the 9-year journey that I've been at Unicommerce for e-commerce growth overall. Where market probably grew at late single digits, we delivered a 15% growth.
So that would be maybe just the post-COVID impact, sort of a high base slowdown effect, right? I would assume.
As a company, besides the fact that the number of transactions continue to grow, we are seeing more and more brands are going online. So we will continue to add more customers. Plus, we keep on launching new products. We launched 2 new products last year, and we will continue to add geography. So there are multiple levers for us to grow as a company. So we are hopeful of continuing to be delivering a growth which is...
So you mentioned in COVID, you were growing at about 35%.
No, the market
was growing at 35%.
We delivered 50% revenue growth.
You delivered 50% during COVID. Right now, what is the pace of growth of the segment market? And what is the sustainable run rate industry-wide that you expect?
See, ultimately, e-commerce is a long-term story, right? We believe long-term, it will continue to give about 25% CAGR sort of a growth, e-commerce shipments. Sure. That's there in our RHP as well. It's there in the industry report. So there may be some soft years, like last year was soft year. Sure. Even to this year also, we are seeing there is slight recovery, but it's still too early for us to comment whether it's a long-term trend or not. But long-term, 5 years out, we believe that e-commerce...
25% CAGR is roughly sort of the trajectory for the segment as a whole, for the market as a whole. Got it.
What about the international business? 4% of your revenues today, you cater to Middle East and Southeast Asia. How much can you grow your international business?
So I think one of the key advantages of us having served a competitive market like India is that our product is kind of ready for these international markets. We continue to invest behind the international business. From a product perspective, the product is ready. All we have to do is take care of local integrations. We are obviously investing behind sales and marketing. So we'll continue to invest that. But we feel India, there's a lot of headroom for growth in India. A large portion of our business will continue to be driven by India. There's a lot to be done within India in terms of adding new customers, adding new products, and international will be one of the strategies.
Is there a mix you're looking at, India versus international?
So I think a large portion will come from India. International will continue to be one of the strategies, but a large portion of our growth and our contribution come from India.
Kunal, just a question. I think the issue is about 276 odd crores at the higher end, right? And I believe this is pure OFS, so the money is not coming in the company.
Yep.
Do you foresee any cash needs? And inherently, I mean, is this a business that throws up a lot of cash? What are the cash levels? And would you require any funding down the line, immediately, say in the next 15 to 18 months?
So last year, our revenues, while you mentioned grew at 15%, our PAT doubled, right? And we are adding cash to our balance sheet every month right now. We already have a good amount of cash on the balance sheet, and the company has zero debt.
How much is the cash now?
70 crores as of end of FY24, but that's increased since then. So here's a company with zero debt, positive cash flows, generating free cash flow, already has cash. So we will first figure out how to deploy the cash we have effectively. Largely, we would look at inorganic opportunities with it because we have no intention of starting to lose money as a company, right? When we've been profitable last many years, last 3 years we've been profitable. So effectively that money can be put to good use in finding good products that are synergistic with our current business.
30-second answer. Why are you going public? Because you don't need the money. Your fund is selling, SoftBank is selling. Why are you going public?
Our holding company is selling, but our fund is not selling. Firstly, we feel, as Mr. Murthy would always say, that Infosys went public and suddenly large enterprises started taking them very seriously. Secondly, our company is only because of the talent we have. Being public allows us to retain and attract good talent. And finally, for inorganic opportunities.
Okay, so branding, more visibility, and being out there on the large scale, the public market platform. Got it, gentlemen. Thanks very much. We look forward to more conversations down the line. And good luck with the IPO as well. Thank you.
Thanks for having us.
Okay, let's move on and talk about the market technicals. A quick check on the markets. In the green now, currently up about 175 points. Mitesh Thakkar is now with us for a quick tech check. Mitesh, it's bounced back, but it's off from the highs. What have you made of the morning so far, and what would be the trades that you would recommend?
So I think, the market with the kind of fall we have had for the last 3 days, a pullback and a bounce back was on the cards, and it happened with the gap up opening today. But the important thing is that we didn't even head towards 24,500, 600, which is the minimum retracement area. And I think, we have seen some supply emerge again from those levels. The structure is weakened. So my idea is that getting past 24,500 would be a tough ask, and therefore sell on rallies would be a good strategy. I think eventually we will head lower, and most likely targets on the Nifty should be a retest of 23,900, which is what we did yesterday. And in the worst case scenario, even 23,500, 550 zones would be tested. So slightly negative structure on the index. On the stock side, I have one buy and one sell call. The sell is on Vedanta with the stop at about 423 for targets of 400. And the buy is on Syngene, which is doing very well today. Syngene is a buy with a stop at 816 or 815 for targets of 842.
Okay, we will slip into a short break on that note. We'll get you more on the market. Stay tuned. Welcome back. Let's talk about the real estate sector now. Will the Finance Ministry review the new LTCG regime for realty? Shireen is joining in with exclusive details. Shireen.
Well, thanks very much. Yes, the blowback and the criticism with respect to the announcements that came in for the budget was specifically focused on the removal of the indexation benefits when it comes to the long-term capital gains regime, specifically for real estate. As my colleague Timsy has also been reporting, and what we are given to understand at this point in time, the options that are being considered by the Finance Ministry, the one that the Finance Ministry seems to prefer is the grandfathering option, whether it will be grandfathered till 2024, July 2024, or perhaps a year beyond that is the question that remains unanswered. But what we are given to understand is that a final decision is yet to be taken. The other option, and that is what we've seen happen even as far as the tax regime is concerned. The old tax regime continues to coexist with the new tax regime, given the option to consumers, to taxpayers, to switch depending on what they feel they most prefer. So will that be the preferred route that the government decides to take forward? We don't know yet, but again, a decision has not been taken. But these are the two options on the table that are being reviewed at this point in time. Now, remember, again, to take our viewers back to the conversations that we've been having, including with the finance minister and the finance secretary, when I put this question to the finance minister a few days ago, asking if the government was considering a review or any kind of amendments, the finance minister had said that she would speak only in Parliament because the finance bill is now the property of Parliament. And when I'd asked the finance secretary had said that in his view, in his personal view, there was no need for a review, but he did make it clear that it was eventually going to be a political decision. So remember, the finance minister is expected to reply to the finance bill in Parliament. It was expected today. We're given to understand that's now likely tomorrow. But these are the options at this point in time. If any relief is provided, it's likely to be restricted to the real estate sector for the purposes of providing some relief that taxpayers felt was necessary on account of the indexation benefits being done away with. A final decision, though, is awaited.
Okay, all right, Shireen, thank you very much for that. So then it's all eyes on Parliament, because that's where the finance minister, as you're telling us, will probably clarify this point. Thank you very much for joining in. Take a very quick break. We'll come back with a market update in just a moment. Well, we are looking at a market which is managing to retain a bulk of that gain, 160, 170 points still up on the Nifty. But need to watch for the banks because that's where the problem is. Even now, ICICI Bank, HDFC Bank, they're at the flat line. So if there's no further decline in the Nifty Bank or these other big banks, then perhaps the bulls can heave a sigh of relief. Mid-cap market's quite all right. We are still looking at a very, very healthy advance decline ratio. With that, it's a wrap on this edition of Trading Hour from the entire team. Thank you very much for watching. Stay tuned. Halftime report up next.